the yen is incredibly cheap, so we continue to try to make money from being long yen. So at the moment we cut our long yen positions back, given that we saw the weakness in the dollar. And so, yeah, we'll be looking for opportunities to go long yen again. So we might see that as the risk premium rises around the government. And so, that's what we're sort of waiting to see there. And in terms of the JGB market, you have to remember that these are domestic investors that hold that. So it's not like the UK where you've got international investors playing the carry trade on UK government bonds. The owners of the JGBs are domestically orientated. So from that perspective, then it will be a different dynamic around the spending there. And if everybody's spending around the world, then how do you select one bond market to take the pain? So from that perspective, the fiscal spending isn't out of line with other countries around the world.
And what about the BOJ? Do you think it's safe to say that they are stuck in this holding pattern for the foreseeable future? I mean, until we get some kind of clarity around the tariff situation.
I think so, and we've seen the disinflation come through. We've seen central banks around the world cut rates, and the US is on hold for the near term. But you're also seeing that the rate of expectations of rate cuts in Europe have come down, so they're likely to hold this week. And so the BOJ holding steady also is fine, because then they can see how policies are going to affect the market. So you give central banks more time, they will have more conviction on what the next move should be.
This combo of the Fed expected to cut and BOJ expected to hike, or although you believe that it's sort of stuck in this holding pattern. That was a very destructive combo, wasn't it? Late last year summer. Yen carry unwind, that led to the market rout, along with several other factors as well. Do you think we can actually see that episode playing out once again? I mean, JGB yields are actually a lot higher than the level that we saw last summer as well.
Yeah, the positioning in the short yen in terms of the carry trade has collapsed. So we've seen that come out. So if you look at, I think the latest surveys, I think the Bank of America survey is out today. You're seeing that investors have gone from being long dollar to short dollar, and probably more back around neutral now from that perspective. So if you think about that, then I think the positioning in currency markets is a lot more even than it was back in August of last year, where you saw that unwind of the carry trade. So therefore, you think about, okay, what are the fundamentals that drive currencies? It's interest rate differentials, it's growth differentials, and it's capital flows. And for us, the capital flows in the US will remain strong. The US exceptionalism, while it has cracks in it, will continue to prosper for investors by investing in these large cap US stocks.
Colin, to your point that, with JGBs, it's mostly Japanese banks, big financials, insurers that own JGBs, right? And this whole idea of a widowmaker trade, right, short JGBs. Initially, you would think, look, why on earth would they want to do that to themselves, right? They'd be shooting themselves in the foot, or rather gutting themselves in the stomach, right? But, the point is, for big financials in Japan for the last decade and more, right, they have not been able to make money at home. Yep. Which has forced them to go abroad and grow through acquisition, right? And now with the prospects of rates rising, including yields, right, they've got the ability to finally start making some decent money at home.
Yes,
so,
and if you use the same lens that you've seen in Europe and in the US, coming off zero interest rates, banks and financial stocks, and that sector has done very, very well, because they're able to get their net interest margins up. So, and if you go back to economic theory, your yield curve should be upward sloping, and therefore actually, once you get through this initial phase, that's why the US is at all-time highs, because it's saying that the economy is going to grow in nominal terms. You know, the split between inflation and real growth, you know, that's for the economists to figure out. But in terms of, if you look at the overall nominal growth rates, if you have higher inflation and higher growth and higher bond yields, you've got better growth prospects. And that's what people missed last year when they were thinking that the US was going to go into recession. They forgot it's actually, a lot of people deal in nominal.